there's this broader question of can you actually value these things? But I will leave that to the chuds on Twitter. You guys can figure that out. We want to be this guy down here. Neuron activation. Monkey sees action. Buy.
Reminds me of myself.
I was expecting you to giggle at this a little bit, Thomas. And then here are the bears who have been sidelined for the last month.
His mouth kind of sus.
Let's jump into the valuation concepts. So first and foremost, what's up with the fees? Obviously, I mean, we've had this kind of contention for a while. Like, all right, different blockchains, different fees. Obviously, Ethereum with high gas fees. When you have a bunch of throughput, whatever, a lot of people are trying to send transactions, gas fees increase. A lot of people have been complaining about that. I mean, just the other day, I spent $150 to re-register some of my ENS domains. So pretty insane. I remember during the Bored Ape, during the other side drop, I paid 2 Ethereum in gas fees to mint an NFT, which was insane. Pretty sickening to think about. I think like overall, I mean, they lost like an abysmal amount of value. I think it was like between like $50 and $100 million. It was just like absurd. And there was a bunch of fallout from that. A lot of questions regarding that. For the sake of what we're going to be talking about, I think it is better to think about these things as taxes. So let's think about Solana, right? This is some of the research that I've been doing. Solana, obviously a very efficient layer 1, very low fees. However, they have a very high inflation rate. It's between 7 and 8%, which essentially, I mean, there's this question. So if a different protocol is in some sort of deficit, how do they raise the revenue? Obviously, you can either increase the fees or issue more tokens, right? If we think from just backing up from an economical standpoint, if a country is in a deficit, what can it do? Well, it can raise its taxes, it can print more money. The reason that some of these fee structures exist is to prevent on-chain attacks. I mean, that's just one of them. And then obviously, I mean, just the tokenomics in general, some protocols will have fee structures in order to, for instance, Solana burns 50% of its fees. So 50% of user fees are going to go and get burned. And essentially what this does is over time, by 2030, I believe the inflation rate on Solana is going to go from 8% to 1.5. So it's going to decrease throughout the years. But essentially you have this question of, okay, like what are the implications of an inflationary token? And then also this question of why would we have lower taxes? So we'll take Solana as an example again. Lower transaction fees, you can incentivize adoptions. Builders want to build on, like you, Thomas, for instance, you've been using layer 2 rollups, right? Polygon, building on different blockchains. You don't have to be spending a ton of money, not a lot of overhead costs for developing different projects on the network. You have to trust the people working on the network, to trust they'll burn them, etc. I mean, these are all kind of factored into the smart contracts, if I'm not mistaken. I don't really know. That's why smart contracts exist. Essentially, this is going to happen automatically. So it doesn't matter whether or not they go back on their word. The tokenomics are all programmed in. So anyways, let's get back to the question of evaluation techniques. Okay. So there is this concept called demand for security model, TOMOC. So essentially, protocols rely or demand the security of the largest agent. So if you're a project, right, let's take you for example. What's the project? Are we allowed to say?
Mesa.
I thought it was Mesa, but no, that was a different thing. Okay, Mesa. You're contemplating, all right, where do I build? With whom do I build? Right, at the end of the day, if you're building an on-chain protocol, you really want, right, security. At the end of the day, you want low transaction fees and security. So there's this concept called the demand for security model. Protocols on chain rely on demand the security of the largest agent, right? So that is going to be an important assumption for considering how we value some of these things, right? Because at the end of the day, the base assumption is like you want a secure blockchain that has low fees, but will kind of be up and running at all times, right? Again, you can kind of branch off, make nuanced arguments regarding Solana. They've had some outages, but we'll just keep it simple. We'll talk about Solana. The first valuation technique is called the largest application multiple, LAM. So essentially, you're dividing the staked market cap of the native asset by the market cap of the largest application. What does this do? Well, it essentially tells you kind of the correlation between some of the largest projects on a given blockchain and the amount of money staked in the larger chain. I mean, again, this is kind of a very vague way of quote unquote valuing different protocols, but essentially, like for instance, Render just migrated onto Solana. Render is, I think, one of the largest projects on Solana. So as soon as they migrated over to Solana, I mean, they had a lot of value locked in their protocol, and this kind of took all the valuation, the LAM valuations out of whack, because now all of a sudden you have this very large protocol in the Solana ecosystem that's whatever. At the end of the day, you're essentially tracking kind of the largest projects on chain and how they grow with the chain itself, right? So if you have a chain that's worth $500 million and you got a protocol in there that's like 250 million, you have a 0.2 LAM, right? So you can kind of value different ecosystems and see whether like Ethereum versus Avalanche, like which one has these larger protocols and, you know, the kind of the market share that these projects have, and then consider, you know, if they were to move to a different chain, how would that kind of affect the LAM valuation? So essentially seeing how much total value capture they get. Pretty simple, right? Next we got stablecoins. Thomas, I mean, I'm sure you've had a little bit of experience, you know, a little bit about stablecoins, but this is interesting. I never thought to think about it in this way, right? So obviously you have these massive stablecoin companies, and they can essentially raise money and issue stablecoins on certain blockchains, right? So let's again take Solana for instance. Say there was a massive capital raise, we'll say $500 million of USD. I don't even know. Mango. I don't know. USDM issued on Solana. I forgot what the native stablecoins are there. $500 million are issued. Well, essentially, if you think about it, like these different stablecoin quote unquote companies have like economic power now in that ecosystem. So say like Solana's worth $10 billion, you get say $1 billion of issuance. Like these stable coins kind of now have like a 10% ownership of this ecosystem, right? So in order to maintain economic independence, like this chain would kind of have to keep up with that growth. So like if Solana wants to remain quote unquote like decentralized in some ways, like you're going to need for the total market cap and the total tokens that just like the average Joe holds to go up, right? If you want to maintain that economic independence. So that's also...
Speaking of stable coins, you hear that USDC is considering going public.
Interesting. That is really interesting. I did not know that.
Yeah, full-ass IPO.
Yeah. Oh, wow, that is really interesting. I mean, I know like Circle has been growing.
Yeah.
Circle or
like Circle would be the
yeah. I remember applying for a job there, and they were like a pretty small company, and now they've blown up. Pretty wild how quickly some of these things are growing. But
that's interesting because it would just obviously provide them with much more capital to grow their stablecoin share and just the stablecoin market as a whole, but also provides another blockchain related, crypto related asset that people can invest in through traditional means.
Yeah. But yeah, I mean, I'm interested to hear your thoughts about this model.
I think that's very interesting. I've never thought about this. That like the stable coin, in a sense, becomes an owner of the company itself. And I guess you want, I don't know. It's interesting. You clearly want stable coin like competition. you also, I don't know. I mean, it speaks to the point. I think stablecoins are like the first thing that needs to be regulated. Like they're the backbone of the blockchain industry, and like I could, you just would have a classic bank run if people even have a sliver of a fear that they aren't backed 1-to-1, or I mean, Tether. People don't know. There's an interesting. I can't remember if I did this with James or with you. Probably, I don't know, weeks ago, maybe months ago. About like there's less USDC in the market, and the argument was that like bad currency drives out good currency, or is it the other way? I don't know. It was I can't remember, man. But did we do that? I don't know. I can't remember. If
I don't think we did. No.
Talked about it, James. It's pretty interesting. Let me see if I can find this. But yeah, I don't know. Yeah, that I've never thought about that. Super interesting. And it's tough because I guess like as the cryptocurrency, you need or as a blockchain, let's say in this case, you need stablecoins to like power your network. Again, they're the backbone. Yet also they can't become too used because
I mean, I don't know if it's power, but just like on ramp,
sure, but it's not only, I mean, it's an on ramp, but also like obviously the name comes from stability. It's hard to, I think that the value of sort of like, maybe in this case we're talking about, I guess more so DeFi, I think the value prop is in like tokenizing assets, and you need to operate in your own currency for that to be like super valuable to you, plus the stability of that as well, which obviously isn't 100% the case, but I think stablecoins, beyond just being an on-ramp, provide a lot of really important value to the ecosystem.
Yeah. No, I think we can. I mean, that in and of itself could be a separate segment, but yeah, I mean, it's interesting to consider. Like, assuming this demand for security model, like if you want to ensure that your protocol remains secure and that nobody's kind of monopolizing ownership of a given ecosystem, like you're going to need stablecoin issuance to grow at a slower rate than the growth of like the total market cap. So yeah, interesting to consider. And then this brings us to our last point, the inflation model, right? So some protocols have kind of a fee structure, whereas others focus on the inflation structure. Some have, some sort of derivative of both or some function of both. Like Solana, for instance, again, you have this fee-driven security budget versus inflation. So what is that question? Well, if you have a high inflation, you're essentially penalizing anyone on the chain for not staking, right? So if you have a 7% inflation rate, and you have a 7-8% staking reward, you're essentially losing out on money if you're not staking. So that penalizes people who are not active. But this is really interesting because kind of within this question, you can also compare token generation, the inflation rate, against the fee revenue. So let's take Solana, for instance. So I think right now, 90% of fees generated on the chain are from voting transactions. So essentially like daily voting transactions for different governance things makes up 90% of the fee generation. So there's a 71 times multiple between kind of what general users are generating through token fees and let me just make sure I'm getting this right. I do not want to butcher this because this is very, very important. Let me take a look at my notes real quick. Yeah, so Solana, obviously we talked about burns 50% of fees. The burn rate is lower than the amount of Solana generated. So, we're talking about this inflation idea. And this is by a factor of 71 times. So pretty much, you're going to need, and that's without considering the transactions that are just voting transactions, right? If we take away those voting transactions and we focus on just like the average day Joe the everyday jokes. Yeah, we would need an increase of 400 times, like just fee traffic in order to have no inflation. So that kind of puts a number on that. So the average transaction, we need to increase that by 400 times to basically zero out any inflation, which is pretty interesting to consider. So that kind of shows you the amount of growth that the blockchain needs in order to not be suffering from inflation and not have any of these disincentives. Pretty interesting.
Very interesting.